Hi guys, Alex here from LFIS. Thank you for joining me in another episode of our weekly macro overview series where we cover some of the major political and economic developments that have occurred over the past week. It's been a very interesting week, a lot of policymaker decisions both on the central bank and government level, which we'll get into shortly. Firstly, in Europe, this week saw the Bank of England vote in favour of increasing the bank rate for the first time in more than 3 years. Officials voted to raise the interest rate from 0.25% from 0.1%, the level that was chosen in response to the pandemic in early 2020. The 8-to-1 vote follows evidence of a very tight UK labour market and more persistent inflationary pressures, says Bank of England Chief Andrew Bailey. Core CPI, of course, being reported last week at 5.1% for November, the highest level in more than 10 years. The decision was followed with warnings by Bank of England officials to further interest rate hikes in 2022 if inflationary pressures persisted. This week in the Eurozone, the European Central Bank announced their plan to exit a €1.85 trillion Pandemic Emergency Purchase Programme, or PEPP, by March 2022. The bond buying programme, which was launched in 2022 in response to the economic woes of the pandemic, is set to end, but the asset purchase programme would be expanded by €20 billion per month to €40 billion in Q2 of next year and €30 billion in Q3. A fall in Eurozone bond prices on Thursday followed as investors absorbed the announcement. Also in the Eurozone, the Purchasing Manufacturers Index data released this week by IHS Markit shows slowing activity as restrictions hit the services sector. The index fell to 53.4 in December from 55.4 in November. Ricardo Amaro, senior economist at Oxford Economics, believes that supply bottlenecks have peaked and are likely to ease in the following months. However, the Omicron variant does bring some downside risks in this area. This figure may fall further as Eurozone countries battle the effects of the Omicron variant, the Netherlands announcing on Saturday that they would enter a full lockdown ahead of the new week. Now looking at the Americas and more specifically the US, following this week's announcement by the Fed of its plan to double the pace of bond tapering amid surging inflation, officials have highlighted expectations of 3 interest rate increases in 2022 as the hawkish-dovish scale amongst Federal Reserve officials shifts the focus on persisting inflation. Powell stated after the FOMC minutes were released that supply and demand imbalances caused by the pandemic, have contributed to elevated levels of inflation, alongside rising inflation. Encouraging economic data, including the unemployment rate falling to 4.2% in November, suggests a tightening labour market may not necessarily need loose monetary policy measures. Looking at the House of Congress, contest has arisen between representatives as government debt levels topples over 130% of GDP. Washington passed a bill this week to raise the debt ceiling by $2.5 trillion to $31.4 trillion to avoid an unprecedented default on debt repayments as opposing Congress representatives contest the new spending plan. Biden has struggled to have his new spending plan, the Build Back Better Act, signed off in the House of Senate as Senator Manchin waits to see if the spending plan complies with Senate rules. If passed after 2021, child tax credits of up to $300 a month per child given to some of the US poorest will unfortunately expire. Over in Asia, the lira, I feel like we've spoken about the lira in every single one of our episodes, but the lira has plunged to new lows, closing the week at 1642 lira against the US dollar after Erdogan announced that he would raise the national minimum wage by 50% to ease pressures on real wage rates. Since the new year, the lira has lost over 50% of its value as President Erdogan intends to make Turkey more competitive in export markets. The fall in the currency's value accelerated in November of this year as the Turkish president cut interest rates further despite inflation exceeding 20%. And despite the latest data on Turkish import demand not yet being released, it is likely that the fall in the value of the lira has made imports more expensive, causing import demand to fall and increase input costs for Turkish producers. Also this week, the Bank of Russia increased the key interest rate by 100 basis points or 1% to 8.5% per annum after inflation data for November was reported at 8.4%, over twice the central bank's target rate. Putin has said that rising inflation is a top issue facing households who have already been strained by years of economic crisis and slow growth. The head of the Bank of Russia has commented, saying that demand for labor is growing, yet in many sectors. However, there are signs of labor shortages across those sectors, adding that if Russia is to hit its ambitious growth targets in the coming years, it must rapidly boost productivity. She went on to say that the current inflation expectations are high, therefore economic agents are bringing forward purchases out of fear of further price increases, which artificially raises the inflation rate. Finally, some more positive news. Broad-based economic recovery has flourished in Australia as positive jobs data shows growth across a range of different sectors. Australian officials reported a record 366,000 jobs were added in November, while the jobless rate fell to 4.6% for November, down from 5.2% the previous month. Risks are still poised to the Australian economy regarding the new coronavirus variant. During the rise of the Delta variant, major Australian cities fell into months-long lockdowns, and with a more transmissible variant looming, a threat is poised to Australia's recovery. And there we have it, another episode in our weekly macro overview series. Thank you for joining me. Do not hesitate to like and subscribe. Also follow our social medias listed in the description below. Two small announcements from me before I let you guys go, which are firstly a big shout out to our research analysts. They deserve some recognition despite being in their first years or their final years. They have remained consistent and contributed a lot to this YouTube channel and our mission with the YouTube channel, and none of this would be possible without them. So a big round of applause to them. Finally, we've made a team decision to postpone the release of our weekly videos just until after exams. We hope to see you guys soon, and if you are a Loughborough student, best of luck, and see you guys soon. Bye now.